Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis welcoming you to my podcast Money Talk for Tuesday the 26th of March. I have the latest business and finance stories from around Asia in this holiday shortened week as we head towards Easter. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's headlines, Premier Li Qiang said Monday that China's economic recovery has been improving since the start of 2024. He told International Monetary Fund Managing Director Kristalina Georgieva and World Bank President Ajay Banga in Beijing on Monday that the improvement is laying a solid foundation for the nation achieving its full-year development goals. He noted that growth in exports and industrial production had topped expectations, and he added in the meetings on the sidelines of the China Development Forum in Beijing that the fundamentals of China's long-term economic growth have not and will not change. The US and Japan are planning the biggest upgrade to their security alliance since they signed the Mutual Defense Treaty in 1960 in a move to counter China. President Joe Biden and Prime Minister Fumio Kishida will announce plans to restructure the US military command in Japan to strengthen operational planning and exercises between the nations, according to a report in the Financial Times. They will unveil the plan when Mr. Biden hosts Mr. Kishida at the White House on April the 10th, according to the reports. The EU has launched probes into Apple, Alphabet and Meta in the first use of its landmark Digital Markets Act, which is designed to rein in big tech's market power. If found guilty of non-compliance, companies face hefty fines that could amount to up to 10% of their global turnover. And Nissan plans to slash the cost of manufacturing its electric vehicles by 30% as the Japanese car maker turns to new partnerships and manufacturing methods to counter the rising threats from Chinese rivals. In a new medium-term business plan, Nissan is targeting an additional 1 million vehicle sales over the next 3 years and a 30% reduction in electric vehicle production costs by 2030, the Japanese car maker announced Monday. On today's Money Talk, we're joined by Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, Will Denyer, US Economist at Gavekal, and in Washington DC, writer and broadcaster Barry Wood. And if you want to get in touch with any questions or comments, then please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks kicked off the shortened trading week on a lower note on Monday, pausing after last week's strong gains that drove Wall Street to record highs. The S&P 500 dipped 0.33% to finish at 5,218. The Dow fell 162 points or 0.4%, closing at 39,314. And the Nasdaq Composite, that was down 0.33% and settled at 16,384. And US stock markets are on track for their fifth consecutive month of gains. The yield on the US 10-year Treasury rose 5 basis points to 4.25%. On Monday, Fed Board Governor Lisa Cook told students at Harvard that the risks to the US central bank's dual mandate of low inflation and full employment are moving into better balance, paving the way for rate cuts this year. In the currency markets, the dollar was sold, while the Chinese yuan recovered from the notable weakness seen at the tail end of last week. The US dollar index was 0.2% lower at 104.1. The Chinese yuan strengthened 0.3% to 7.21 renminbi, rebounding from 4-month lows after the People's Bank of China set the trading band for the renminbi at around 7.10 renminbi per dollar. That's stronger than estimates. The Japanese yen was unchanged against the dollar at 151.4 yen after Japan's Finance Vice Minister Masato Kanda said the currency's current weakness didn't reflect fundamentals, and he described recent moves as speculative. The weaker dollar pushed gold marginally higher. Spot gold ended the day 0.33% firmer at $2,171 an ounce. Brent crude oil settled 1.5% higher at $86.75 a barrel, and Bitcoin gained almost 10% to trade above $70,000. It's at $70,718 at the moment. Hong Kong stocks closed in the red, dragged down by financials and the tech sector. The Hang Seng Index shed 26 points or 0.2% to close at 16,474. Technology shares dropped That was after the Financial Times said Sunday that China has launched new guidelines to block Intel and AMD chips in government PCs and servers as Beijing sought to help its semiconductor industry. The Hang Seng Tech Index was 0.5% lower. PC maker Lenovo sank 8.6% in Hong Kong. Mainland China's CSI 300 index ended the day 0.5% lower at 3,526, marking its third straight day of losses. Looks like the Hang Seng is going to open about 18 points higher at the open this morning, around about 16,490 according to futures markets. And you can get more details on the latest market movements in my daily newsletter, which is at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Time to welcome our Tuesday morning guests. We have with us Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia. Morning, Mark.
Good early morning, Peter, and good morning, Will, and good evening, Barry.
And we have with us Will and Barry, our Will Denyer, who is US economist at Gavekal over in Hong Kong. Morning, Will.
Good day, all of you.
And over in Washington, D.C., we have our US economics correspondent, writer and broadcaster, Barry Wood. Is it warmed up there yet, Barry?
Not yet. I think I brought the cold weather from the Middle West right back to D.C., but good morning to you.
Good morning. Okay, well, let's start in China then. I think it's pretty chilly there as well at the moment. Premier Li Qiang said Monday that China's economic recovery has been improving since the start of 2024. He said that the improvement is laying a solid foundation for the nation achieving its full-year development goals. He noted growth in exports and industrial production had topped expectations. This was in a meeting on the sidelines of the China Development Forum in Beijing, which has been going on since Sunday. He said the fundamentals of China's long-term economic growth haven't and will not change. And in his keynote address at that forum on Sunday, Premier Li downplayed concerns about challenges facing the economy, and he reassured investors that Beijing will step up supportive measures for growth, while he acknowledged in his speech that many people are concerned about risks in China's property sector and local government debt. He said some difficulties and problems are not as serious as people think. Mark, I'm noticing a change once again in the way Beijing is presenting this now. They seem to now, at the moment, be downplaying the difficulties with the economy and saying they're not really as bad as people think.
Yeah, and of course, we hope he's right. But whenever anyone in an official position says some difficulties and problems are not as serious as people think, that always worries a lot of people. And the specifics, again, are not very clear exactly what they're going to be doing, how they're going to be doing. You expect them to lay out everything, but at least something more specific. And what's missing also is the discussion that has traditionally taken place at this meeting with the premier, which is sort of not quite informal, but relatively informal between the executives and the premier. So yes, things look a little bit better, but it's going to be, I think, still hard going to reach their target. They probably will find a way to do that, but it's not just clear how it will. And the property sector is still that overhang, among other worries.
And what's going on there? Premier Li Qiang seems to not be holding any of these traditional meetings that he would hold with investors and company CEOs, either at the two sessions or this forum either, which is normally the traditional way for him to engage, isn't it, with business leaders and government officials. It seems to be done instead now by President Xi Jinping, who is going to meet some Western CEOs on Wednesday, according to reports.
Yeah, and that's a big meeting. Others should talk about this as well. Yeah, clearly, and it's and the premier has had experience meeting Western executives, especially when he was in charge of Shanghai during the time, of course, during the time of COVID, but as well as working with industries and companies and executives. So, I'm not sure what signal it says, but I think it's good news, at least, that the president is apparently meeting tomorrow with a lot of senior executives and also the heads of two of the major U.S. organizations that deal with China business.
Well, haven't we heard all this before? A lot of talk about the economy, not as bad as people think, steps to support growth, to encourage foreign investment, but not a lot of action.
The charm offensive is important here because here he has the multinational executives, and China wants more FDI. And last year didn't quite meet expectations. Maybe that's a nice way to put it. And you know what? Let me just end by saying that executives have three choices. They probably have more than three choices, or the three approaches. One is to double down in China, and some have done that in chemical and other areas. In other words, they're increasing their investment. China plus one, China plus two is another one, and then a few have left or have pulled out to a great extent. So, and it's there's a balance among them. Let's put it this way. So the uncertainties are still there, although the commitment to China, at least among our members, is still pretty strong.
Well, still a lot of tensions, though, aren't there, between the US and China, which are weighing on both sides, really. The latest being now this report that China's trying to get Western chips made by Intel and AMD removed from government PCs. I mean, it's not really, these things don't really chime with the talk, which is that China's open to foreign investment and we want foreign companies to come here.
Absolutely. But it is consistent with the general discussion, and the U.S. has itself to blame for this. I mean, you can't really blame China for taking measures like this when the U.S. is also trying to stop the flow of technology between the two countries. I think it's a shame.
But what is it that the U.S. Seems to want from foreign investment? Because it's not even just China, is it? I mean, look at Nippon Steel, for example. It doesn't want, US Steel, it doesn't want Nippon Steel buying it. Are there whole sectors now in the US economy that are sort of off limits to anyone who wants to buy, to take them over or buy them?
Well, excuse me. Sorry, running with a bit of a cold. This is an election year, and so I do think everybody's up on their soapbox trying to do things that are politically popular in the U.S. And right now, protectionism is unfortunately quite popular. So I'm afraid we're getting a lot of that. I'm not sure there's, when it comes to stuff like steel, it's, I have my doubts that entire sector is going to be off limits. Certain deals they may get in the way of, but it's the higher tech stuff that they seem to be targeting more specifically.
But why is steel a national security risk? The Biden administration seems to sort of think it is, isn't it, if it falls into foreign hands?
Yeah, I mean, I guess you use steel in ships and, military
yes.
ships and all. But, if you go that far, you can include anything, right? I mean, the military needs to eat. The military needs to... you can go as far as you want. I mean, Barry, this is more your wheelhouse. Do you have something to say?
Well, I do have a rather, I think, strong opinion on U.S. Steel. This is a company that has been shrinking for 30 years, and they did try an expansion into Eastern Europe. They had a very successful plant in Slovakia. I think they sold that to the Indians, and the Indians have bought up a lot of the steel capacity here in the United States. The United Steelworkers Union got President Biden's attention that this deal would have just, I think, not sailed through, but it would have gone through easily. I still think it will go through because I don't think President Biden wants to be seen as the guy who opposes all cross-country, cross-border mergers. Now, I think, as Will said, when you get into technology and when you start talking about China, then it's a different story completely. The one to watch, of course, is TikTok. And to see what happens in the United States about either forcing this sale from ByteDance or whether they will simply let it die in the Senate. But yes, there is protectionism in the states, but it's not as strong as it was under President Trump.
It's rather odd, isn't it? Because here we have these reports of the US and Japan forging closer military alliances and sort of pooling some resources. Kumio Fushida's going to go to Washington in a couple of weeks' time to meet with President Biden. They can do this. They can work together militarily, but they don't seem to be able to make steel together. Yeah,
look, I don't want to minimize the importance of this U.S. steel Nippon Steel merger. It's very important to see how it goes, but I think it's early innings. And yes, I think you've raised the question. I mean, you're going to cooperate on building ships and in fact integrating your military commands in Japan, and yet you're going to say that a leading steel company in Japan cannot buy an ailing American company? Doesn't make sense to me.
This isn't new. I talk about this in my class, but under George W. Bush, who was more or less a free trader, that you remember free traders. They used to exist. They don't so much anymore. But anyway, the Steelworkers Union, again, tried to intercede Chinese tires coming in to the U.S. These were cheaper priced tires. Actually, Goodyear and other major tire makers were in favor of them coming in because they couldn't make the tires profitably at that level. But again, it was the steel makers, and the Bush administration actually imposed sanctions. So even then there was a lot of pressure, and that pressure, I think, has probably grown considerably.
Before we move on from China, let me just ask you about Kristalina Georgieva and her comments there. She was using the same term, really, that President Xi Jinping was using, which is that China is at a fork in the road and needs to reinvent itself for a new era of what she called high-quality growth. That's very much President Xi's words, isn't it? And if they do this, they could add 20% to their economy over the next 15 years. What do you say to that?
This is about as far as the head of the International Monetary Fund can go. And as you suggest, Peter, she got a powerful assist from Xi Jinping, because if this is compatible with what he said, then she can say it. But that's very significant that the fund would say, well, you're going to get so much more money if you open up further. The fund has lost a lot of its influence in the last 5 years since Christine Lagarde left. I think that it's not to be assumed that the fund is an important player in the Chinese economy. Certainly, there's nobody looking for money going into China from the fund. But I think what is really important to the Chinese is they want more power in the IMF. And they're probably going to get it, but slowly. So, yeah, it was a nice speech from the Bulgarian head of the fund, but I think it'll be forgotten in a couple of weeks.
China values the IMF. They do. Of course, part of the reason is Barry just described. They want to have more power within it, but they feel that there has to be some kind of organization like the IMF, and the IMF is really the only one that exists and has existed for 80 years, as we all know, to mediate the financial issues. Of course, they would like to be a major player in deciding what those are going to be. So I think they listen. You're right. I don't know how much change there's going to be, but they are at a fork of the road. And to quote a famous philosopher, "Come the fork of the road, you take it." Whatever that means. That was Yogi Berra. But anyway, but talking about boosting the spending power of individuals and families, they're talking again about hukou reform, which they've been talking about forever and ever, and boosting the support for rural workers that are coming into the city. The problem again remains, as it always has been, the big cities are resisting it, the Shanghais and Beijing, because they have their own financial problems and they don't want to pay for these migrants who are coming into their city. So, and that wouldn't do it alone, but it's healthcare, it's housing, it's education. This does help confidence, and it would help confidence. So that's, a big worry for our companies, of course, the consumer confidence, and that it's not coming back nearly as quickly as they'd hoped.
Okay. Let's move on and talk a little bit about the central banks that met last week. And, we had quite a lot of them, didn't we, meeting last week. There were some surprises amongst it. Maybe the Fed, in terms of its sharp revision up to economic growth and also its revision up to inflation. Switzerland surprisingly cut rates. A couple of others raised them, the Bank of Japan and Taiwan. Do you think we're getting to the point now where maybe central banks are starting to sort of lose their fear of inflation and are attentively stepping towards cutting rates?
For the U.S., I think no. And there is actually a point of disagreement within our firm on this, and I'm sure within a lot of firms on this. The Fed did note that we had a couple of hot CPI releases recently, and yet has not changed its view on expecting rate cuts to be appropriate at some point this year. And the dot still suggests 3 cuts by the end of the year. That is not a commitment. That's just their projection. And so the big question is why? Is this because they see 2 months of hot CPI after 18 months of decelerating inflation data as noise, or in Powell's words, a bump in the road, and they're still committed to the 2% inflation? Or do they not even care about the 2% inflation anymore? And in reality, they're willing to accept something higher than that. And so that's why they're continuing to ease regardless of some couple of hot inflation numbers. Which of those two scenarios you favor has huge implications for the markets, because it tells you something about the risks involved going forward. If you think the Fed is still committed to 2% and that they see this as just noise, which is my view, then inflation needs to prove itself to be just noise. When the next few CPI numbers and PCE inflation numbers need to be softer, otherwise it's going to be harder and harder to argue this is just noise. It'll start to look like a trend, and then rate cuts could be off the table. If you think that the Fed has without saying it, in fact, while saying explicitly the opposite, but in reality they're abandoning their 2% target, then we're going to get rate cuts regardless of what inflation does, which is a possibility, but I favor the first interpretation.
But that second interpretation is a risky path, isn't it? Historically, when central banks start cutting rates before inflation has got close to their target and while GDP growth is above trend, you're taking quite a big risk there.
Yeah, I mean, central banking is risky business to begin with. The problem that you have is that you have a delayed reaction to any policy changes in the data. And so, it's been described to me before as, trying to back up an 18-wheeler, looking in a mirror that has a, 1 minute delay in what you're seeing. You're quite likely to, fork it or hit something. And that's why, quite often we don't get soft landings. So the Fed so far has apparently done an amazing job of achieving a soft landing, and they may just pull it off. But it's a difficult game. But I think your point is valid, that it is risky to cut rates before we get to solidly to 2%. But it's also risky to wait because of that lag. You could drastically overshoot. And so that's the art of it. That's the difficulty.
So is Jerome Powell saying here he really wants to protect the labour market? Is that what he's saying there?
Yeah, I mean, I think Powell, a year and a half ago, Powell was saying we have got, inflation was very high. And he said, we have got to get inflation down. And if we cause some pain in the labor market, which we expect to do, that's just what we have to do. And it would be a lot worse if we just let this inflation situation get completely out of hand. They have been pleasantly surprised, and I have been, and most people have been pleasantly surprised at how little pain that they have had to cause in the labor market in order to get inflation down. And so, yeah, I guess he, to the extent that he can, he wants to protect the labor market. The way I put it is this: look at the Fed's two targets, or they've got a dual mandate, right? Their target for employment is maximum, as much as we can get, which is not really a target at all. Their target for inflation is a very specific number, 2%. And so if you have two goals and one is very specific and the other one is totally vague, what happens? Well, your inflation target becomes the primary one, and you'll basically get as much employment as you can while you're targeting that specific inflation measure. So I think inflation is primary.
Peter, I agree with Will. I think that the 2% target on inflation is real, but the markets probably do expect 3 rate cuts, as the Fed says it wants to do. I think they'll be lucky if they get 2. But the important element here is the looming presidential election, because I actually got this information from the previous Peter Lewis podcast, because the Fed probably needs to act in June, and then maybe doing something July, August. After that, it's too easy to accuse the Fed of bowing to political pressure. and wanting to reelect Joe Biden if he's the candidate. So, I think we're going to see rate cuts. The markets are happy. The unemployment rate is low. Employment gains are real. They've been revised downward, but they're real. So I think, as Will said, the Fed has done a pretty good job.
Mark?
Barry, I actually did a little bit of analysis on that topic of timing and elections. And I was actually a little surprised at what I found. So I do agree with you that I think the Fed wants to be seen as apolitical as possible, which means they would prefer not to start a rate cutting cycle just before the election. But I would describe that as a preference, not a rule, and even so much as a soft preference. If the data or economic developments suggest, okay, it's time to cut, yes, the election's in 1-2 months, they'll do it. And at least that's been their history. So I went back to the early 70s and looked at, there was 13 elections years during that period, I think early 70s, early 60s. Anyways, the last 13 elections, out of those 13, 5 times they cut rates in the April to November or October period before the election, which is what the period we're in now. 5 times they hiked rates, and 5 times they held rates steady. Okay, now that adds up to more than 13, and that's because in a couple of those years they both hiked and cut. Okay, so if you don't double count those, what you find is that 8 out of the 13 times they were changing rates in that period, and only 5 were they holding them steady. And some of them were even closer to the election than June. Some were in the few months right before. So I agree that would be their ideal preference, but I think we need to be prepared for cuts or hikes at any point. Hikes at this point would be pretty unusual, but it's possible.
All hell is going to break loose, isn't it, with Donald Trump if the Fed starts cutting rates in the couple of months before the election?
Yes, if he's the candidate, I think you're right.
Mm.
And then if he's president again and they start hiking rates, all hell will break loose again.
Even more.
Yes.
but the dot plots.
Get your popcorn out.
The dot plots are very, very close to it actually only being 2 rate cuts this year, aren't they? 9 out of the 19 were projecting 2. It only needs 1 more of those to change their minds, and basically you're down to 2 now this year.
There's an increasing number of people saying that there's incipient weakness in the economy, particularly in the housing sector. And if Chinese deflation is going to cause a lot of the goods in the big box retailers to hold steady or go down, that will ease the inflation threat. But I think the real problem could be delinquencies on credit card debt, and we need more data. But I find what you just said, Will, very significant. And as I listen to you, I'm thinking, gosh, the Fed must be pretty independent.
Yeah, I think we'll see. You two know a lot more about it than I do, but we'll see how Jay Powell reacts. I mean, he's under direct attack by Donald Trump in the campaign, as we know. When you think back to the 70s, not necessarily the early 70s, but you had people like Paul Volcker, who I don't think was too afraid of anyone. But I'm not sure if we have that situation now. But that historical summary really helped, I think.
Well, on that, I think Powell would prefer not to have Trump as president again. He wasn't very kind to him the first time around. That being said, I don't actually think it changes policy much, either before or after the election. And the reason why is because the best thing Powell can do for Biden is achieve a soft landing. You know, a recession wouldn't do Biden any favors. And looking soft on inflation as it's rising would also not do Biden any favors because his poll numbers have been hit by inflation. So I think Powell will try to do what he was trying to do regardless of politics. And then after the election, if Trump wins, I don't think Powell is going to get another term in 2026. But at the same time, we saw in 2018 and 2019 that Powell has a backbone and he's willing to hike rates, do QT, do whatever he wants to do, even with public lambasting from Trump. And so I would expect that again if we get another Trump presidency.
I feel better already. Thanks, Will.
Will, what sort of state is the US consumer in?
Right now, they're in a good state. So we've got a tight labor market still. It's still showing cracks, but it's been showing cracks for a very long time. You can point to different pockets of weakness, and there's no doubt that it's softened from red hot levels. I'd describe it as going from red hot to lukewarm, and somewhat more imbalanced than it was before. But it's still tight, and so the consumer has a job, has income coming in, and at the same time they've got a wealth effect that had abated a lot in 2022 on the back of Fed tightening and a sell-off in both equities and bonds. But over the last 18 months, that has rebounded on the back of asset prices rebounding, and so now we're starting to see a positive wealth effect come into effect again. So yeah, they're in a pretty good state right now, as long as we don't get some. It's gone on long enough that I'm now, I used to be in the recession camp, and we have to recognize the fact that it looks increasingly likely that we're going to get the soft landing. But I wouldn't completely rule out the possibility that we get a delayed reaction to monetary tightening and we do get a recession at some point. And then, of course, the situation changes very quickly. But for now, they're in a good place.
What was interesting in the press conference last week was Jerome Powell didn't really acknowledge at all the financial markets and how much they're sort of loosening financial conditions. So when the Fed says, rates are at a fairly restrictive level, they haven't really taken into account, have they? You have stocks at record highs, all sorts of other asset classes at record highs as well, like gold, like Bitcoin, pretty close to record highs anyway. This is sort of loosening financial conditions, isn't it? But Jerome Powell never really addressed that.
Yeah, I
you're
agree.
right. Sorry, go ahead, Bert.
Go ahead, Will.
No, it is interesting they didn't bring it up. Maybe he's just tired of talking about it, because I think the last 15 sessions he has talked about it. It's always a tough one. They have, generally speaking, I do think they've tightened financial conditions. Real rates are up significantly. Now, have they tightened enough? The fact that asset prices have rebounded, one interpretation of that is that they have not tightened enough. But then again, their mandate is not to keep asset prices down. Their mandate is to keep inflation down. And so far, they're doing okay on that. Go ahead, Barry.
Yeah, Powell likes to use the term restrictive, and it is a restrictive monetary policy compared to where we were a couple of years ago. I do think that there is cause for worry when you look at the Bitcoin price, and there's cause for worry when you look at the NVIDIA stock run up, and there's some concern when you look at the gold price, which is at record highs. That must be telling us something. I'm not sure what, but otherwise it's clear sailing, and Will has got it right. The market looks very strong. The consumer looks very strong at the moment.
Those magnificent 7 tech stocks that we've talked about many times with you on this show have now turned into just the terrific 2, haven't they? It's just NVIDIA and Meta now that are really doing all the hard work. The others are starting to fall away.
So it seems, and I think you could make the case maybe that's healthy.
Yeah, I was going to say that as well. There is, so the equity market rally right now is a little bit hard to describe, because in some ways, and it's actually the best of both worlds. In some ways, it is broad-based. If you look at since October, the trough in equities, the S&P 500 or US MSCI, any major US equity index you look at, the market cap weighted index and the equally weighted index have performed roughly similarly, which suggests this is not just about 2 or 3 huge stocks. If you look at sectors, all the sectors are up 10% or more. We've got 4 sectors that are above, beating the index. Obviously, you've got technology, you've got communications, but you've also got financials and is it industrials? There's one other one that's beating the market. So it is broad-based, but at the same time, you are seeing investors distinguishing between different companies. And like you said, the Magnificent 7 has become the Magnificent 2 or 3. So that I do agree that's healthy, and that's maybe one reason why Powell is not so concerned about the equity market run up. But I think gold and Bitcoin is another story.
The long-term look at equity markets reveals lots of things, but certainly since 2000, 2009 and the recovery from the great financial crisis, the United States equity market has just gone gangbusters, 400%. And then if you just go back to October, you've had 110% increase in U.S. equities. And as listeners in Hong Kong and certainly the mainland and elsewhere in Asia know, excepting recently Japan and certainly in Europe, there's been nothing matching the United States equity performance in the world.
Mm. Well, this year we've got Japan, haven't we, Mark? That's not quite as good as the US, but nevertheless a remarkable turnaround in equities there. And of course, the Bank of Japan's now started its rate hiking process, although minimal steps, 0.1 of a percent higher to take it to zero.
Like Claude Range said in Casablanca, I'm shocked. I'm shocked by the Japanese approach. It's with a few exceptions, it's slow but steady. So we're talking about a 0 to a 0.1% rise in the rates, which isn't major, but of course by Japanese standards, first time in 17 years. Wages are the highest they've been up since the early 90s. About 33 years. And so in that sense, it is sending signals. But, of course, the currency markets, and others can comment on this, haven't been too impressed by this, as you can tell, because the yen, despite raising the rates, not admittedly very dramatically, the expectation is they're not going to go up too fast. It's going to take a while. And maybe if there is a next rate increase, the thinking now it might be October. Could be July, but might be October. And then again, another minor increase. But still, it's a turnaround and trying to focus again on stimulating the economy. And again, Japan, like China, is trying to get private consumption expenditure in the middle of stimulating that economy. And they have issues trying to do that as well, even though there is money in the economy in those consumers as there is in China. But they haven't been spending it nearly as much as they would like. And so that's another issue that the Japanese government wants to look at, and the Bank of Japan.
The key thing is whether those wage increases broaden out, because the Shunto wage negotiations are big companies, aren't they, which are maybe 30% of the economy, but 70% of the economy is small companies, and it's much harder for them to raise wages by 5%. That's far more damaging to them. So that's going to be key, isn't it?
Yeah, exactly. And that hasn't always happened. It probably, who knows? But it will have some effect probably. It just might not be nearly as much. And it's a question of how that translates into spending and to helping to stimulate the economy as well. And if Japanese business people, consumers, and others feel confident that Japan is sort of moving in a different direction, they're moving in a different direction, but as usual, not too dramatic, at least at this point.
Well, what are your thoughts on what the Bank of Japan has done? Is this the beginning of a sustained period of rate rises, or is this just a one-off and we're just going to see very minimal steps from here?
Well, the market's very clearly taken the latter view, and I have to say I was pretty surprised that we didn't see at least a little bit of strength in the yen between the combination of Japan hiking rates, admittedly a small amount, but we weren't expecting them to pull a turkey and hike by 500 basis points. So they did basically as much as you would expect them to do on the rates. And then at the same time, the Fed coming out and saying, we're not panicking over these CPI releases. We're still planning to cut rates. Getting both of those news items in the same week, you would have thought, and also the Fed said that they're going to taper QT sometime this year. You would have thought that would have boosted the yen and weakened the dollar, and we didn't get anything of the sort. So searching for explanations, the best one I could come up with is that the Bank of Japan said that they're going to continue to buy JGBs at the same pace that they were buying before. And so, maybe that's one thing that said, okay, listen, this is a very, very slow change that they're making. The rates, yes, they bump those up, but they drop yield curve control, but then say they're going to keep buying JGBs. So is this sort of a distinction without a difference? So that's the best explanation I've been able to come up with.
I mean, at the end of the day,
Oh, go ahead. That's the issue. And we actually, IMA, we actually forecast that the yen would not strengthen substantially for many of the reasons that Will just outlined, actually.
Mm-hmm. Well, you've still got this large yield differential, haven't you, between US dollars and Japanese yen? That's not going to go away anytime soon, which is not very good for the yen. And presumably several Asian currencies are in the same boat, really, aren't they? The Chinese yuan, for example, we saw a big slide last Friday in the Chinese yuan. It looked like the PBOC suddenly was going to be happy to let it slide, although they changed their minds yesterday on that, or at least sent out a signal that they didn't want to see it weaken too much. But things not looking good really for the Chinese currency either, really. It needs to weaken as well, doesn't it?
Wei from our China team, he's actually putting a piece out on this today, and I don't want to front run him on that. But I think one of the initial explanations that they're seeing, and this is not very satisfying, frankly, that a lot of it has to do with the dollar strength. They do tend to manage against a basket, but the dollar weighs quite heavily in that. I'm waiting to see what else he writes on that. Anybody else have views on that issue?
Only to say that from my perspective, the change in Japan, slight as it may have been, I think is very significant. I think it indicates that the Japanese are moving towards normality, and that's very positive, reflecting the strength in the Japanese equity market.
Mm-hmm.
Yeah, it only took 17 years.
I mean, it's also true, isn't it, that Japan's got its demographic problems as well, in some ways similar to China. There is a shortage of workers because the country is getting older. The birth rate is declining. So in some ways, the companies have got to do their best to hang on to the workers that they've got.
That's also been going on for 17 years.
A little longer than that. And, it's the fastest aging developed economy by far, and they don't let people in. That's, Abe tries to change that a little bit and a few others. But, I've mentioned this before, but the saying was that some Koreans have lived in Japan for 300 years and still aren't citizens, which is maybe overstating. And anyway, but nonetheless, it's an issue. So they're coping with it as their population declines, as you mentioned before. But clearly, that's got to be in there. That's got to be one of the factors they have to consider.
And in the meantime, Japanese equities, they're at all-time highs, above 40,000, above 41,000, I think, weren't they, at one point last week? It's all still looking pretty rosy for the Japanese market as well this year.
Yeah, I mean, I think a lot of stuff has culminated in a bullish story in Japan. And, there's been some improvements on corporate governance. There's been, had a very competitive yen. You've had generally good global growth, and China has been seen as uninvestable. And so if you've got money to invest in Asia and all of a sudden China's not an option for you, then you look elsewhere. And one of the obvious places to look is Japan and perhaps Korea as well, looking forward. Could be another recipient of those. Now, what's interesting is that all fits when you look at the equity story, but you would think that would mean some strength in the yen, which we're not seeing. Some weakness in the yuan, which we have seen. So the currency story doesn't fit that narrative quite as well as the equity story.
And where do treasuries?
As we discussed before. Oh, go ahead.
No, carry on, Mark. Sorry.
No, as we discussed before, foreign direct investment too is become more attractive. It's not going to be overwhelming, but companies that have higher tech, low labor cost, low labor intensive sectors are looking again at Japan. And these are international companies, including ones from Taiwan, like TSMC, which is setting up a plant there and that's gone a lot more smoothly, for example, than the one they've been trying to set up in Arizona for various reasons.
Well, let me just finally ask you, what's the outlook looking like for treasuries in this type of environment?
Yeah, I mean, I think right now, the way I would describe it is the risk reward profile is just better on T-bills than on bonds. I'd rather be buying something with a higher yield and less risk at this moment than buying long-term treasuries that offer a lower yield and more risk. Now, they could go down if we get a deterioration in growth, particularly And the fact that the Fed is marginally slow, is expecting or is planning to slow quantitative tightening, maybe that's a marginal positive for the bond market. But we do still have a lot of supply coming online. The Fed is still contracting its balance sheet at some pace, even if it's slower. And so, and you've got demographic situations that provide a long-term structural uptrend to yields. I think that can be dominated in the near term by developments, but putting it all together, I'm with Barry. I think there's slightly more upside risk than downside risk to long-term treasuries, and it's just not worth taking that risk if you're getting a higher yield on the short end.
Okay, well, thank you very much for your thoughts this morning. Great to hear you. That's Will Denyer, who is US economist at Gavekal, Mark Michelson, who is chairman of the Asia CEO Forum at IMA Asia, and our US economics correspondent over in Washington, D.C., writer and broadcaster Barry Wood.
You're listening to Peter Lewis's Money Talk. Money Talk.
Thank you for listening to Money Talk this morning. You can find more business and finance information from around Asia in my daily newsletter, which is at peterlewismoneytalk.substack.com. On tomorrow's programme, I'm joined by Alex Frew McMillan, a freelance writer and Asia columnist for TheStreet.com, and Andrew Sullivan, who is founder of Asian Market Sense. And with a view from Japan is John Byrne, who is principal economist at the Asian Development Bank. Bye for now.
Money Talk.